Yo, it's your boy Felix, and welcome back to another interesting episode on 12 with FX. And today I'll be analyzing the Wema Bank PLC, which is a public company that is traded on the Nigerian Stock Exchange market. So without further ado, let's jump right into the market. Whenever I'm given an asset, the first thing I always do is to try to get the direction of the market. And one of the best ways of getting the overall direction of the market is by going up to the higher time frame. Anything from the daily down to the monthly are all considered a higher time frame. The reason why I always go to the higher time frame is because this is where institutional traders take their direction from. And secondly, going to the higher time frame gives me the overall perspective of the market. So it would be a good idea to do that. So when it comes to the market, there are only three phases you can see the market. Either the market is making higher highs, higher lows, or the market is making lower lows, lower highs, or the market is moving within a range. When the market makes higher highs, higher lows, just know that you're in an uptrend. When the market makes lower lows, lower highs, you are in a downtrend. When the market is moving within a range, so it's like a ranging market. So in this case, the market has been making lower lows and lower highs. This was a high, a low, a high, a low. This high was higher than this high. This low was lower than this low, so this is a high, a lower high, a low, a lower low, a lower high. This was a high lower than this high, and a lower low. So the market has been making lower highs and lower low. And when the market makes lower highs and lower lows, just know that you are in a downtrend. And whenever you hear the word trend, just picture a 5-wave pattern. A trending market unfolds in a 5-wave pattern. And at the end of the 5-wave pattern, what comes next is either a retracement or a reversal. A retracement is just a minor pullback that will lead to a continuation of the trend after the pullback. But a reversal will lead to the formation of a new trend entirely different from the previous trend. So in this case, we had a lower lows and lower highs. This is a first wave, second wave, third wave, fourth, and fifth. This is like a textbook explanation of what's happening down there, because the market is making lower lows and lower highs. Even though it doesn't look exactly as what's happening down there, the overall idea is what you should pay attention to. So lower lows and lower highs, and at the end of this 5-wave pattern, what to expect could either be a retracement, which is this A, B, C, and a continuation of the trend after the retracement. So a continuation of the bearish downtrend. On the other hand, at the end of the 5-wave pattern, what could also expect will be a reversal, where this will lead to the break of the structure and a formation of a new trend entirely. So after the 5-wave pattern, what to expect next will be a reversal. So in this case, going back on the chart, this is the 5-wave. This is the first wave, second, third wave, the fourth, and the fifth wave. And what comes is either a retracement or a reversal. And I said a reversal will lead to the break of this upper trend, because it leads to the formation of a new trend, which will be an uptrend. But since this hasn't broken the upper bound of the market, I'm going to treat this as a retracement. So a retracement will be an ABC pattern, where it's a 3-wave pattern. This is the A, the B, and the C. The A wave is always a 3-wave pattern. So in case you haven't watched my videos on market structure using Elliott wave, I will recommend you to watch it in order to understand my analysis. The A wave could either be a 3-wave pattern or a 5-wave pattern. So if I can zoom in, so this could either be a 3-wave pattern or a 5-wave pattern. So in this case, we got a 3-wave pattern. So this is A, B, C. This one, different color. The B wave is always a three-wave pattern. This is the B wave. This is the A, B, C. Wave is always and the C wave is always a five-wave pattern. So with the end of the trade, with the aid of the trend channel, I'm gonna get the five-wave pattern. So this is the first wave, the second wave, the third wave, the fourth wave, and the fifth wave. So guys, this is just like me explaining this whole thing based on the market structure. But in order to understand what is essentially happening in this market, one needs to understand the psychological aspect of the market, which we introduced briefly in this recording. So I'll first start with liquidity. What do you mean by liquidity? So I always, if you watch my previous videos, I always make mention of liquidity all the time. So when you say liquidity, it means like a pool of money resting at certain areas in the market. So you have areas in the market where you have a lot of money resting there due to the actions of the traders involved in the market. So in this case, I'll first start with external liquidity. You have external liquidity and you have internal liquidity. You find external liquidity at major swing areas in the market. Like you can see that this was a major swing area. This was the first wave, second wave, third, fourth, fifth. So at the end and beginning of major swings, that's where you find external liquidity. So you have at this area, the market, you have an external liquidity resting above here because institutional traders sold heavily at this area. So you had their stop loss placed above this area. And secondly, you also have retail traders that sold at this end, so that you have the stop loss placed above here. And also some retail traders, they call them breakout traders, that see this as an area of resistance, and they hope that once the market breaks this, they'll take a buy trade. They've also placed a buy stop entry at this area. So what happens is that you have the stop loss placed below here from retail traders. So the contribution of retail traders having a stop loss placed down here, and also institutional traders selling heavily at this area with a stop loss placed above here, constitutes a pool of money, and that money is what we call liquidity in the market. So you have money resting above down there, and like I said, at the beginning and the end of major swings. So this was the beginning of this swing, and the end of this swing was here. You also have money resting down there because institutional traders also bought down there. They also mitigated that position at this area. So you have them buying around there. So you have money resting down there. So this is like a major swing in the market. And also, another place where you have a major swing is at this area down here. At this area down here, because institutional traders sold heavily at this area down here, so they had the stop loss placed above this area. Another place where you have external liquidity is at this area down here, because institutional traders, they bought heavily at this area that led to this movement in price. So you had liquidity resting below because you have that stop loss placed below here from buying. At the same time, you have liquidity rest and above these ends because institutional traders sold heavily at this area, and you have the stop loss placed somewhere around this area. So that stop loss constituted liquidity. And similarly, you have external liquidity placed at the end of here, because this is like the end of this major swing, and secondly, the bots this market that led to this movement, this bullish movement in the price. So you have that stop loss placed below here. And major swing, this is an A, B, C correction. So definitely this was the end of this A wave. So you have money resting above here because institutional traders, they sold that led to this movement downward, that led to the formation of the B wave. You also have external liquidity resting down here because at this area they bought, you have that stop loss placed below here that led to the movement of this price down here. So at the end at the end of this C wave, you have external liquidity resting down here because it's in between this major swing. So the start and beginning of the swing. So that's what you call external liquidity. Just the way you have external liquidity, you also have what they call internal liquidity. And internal liquidity is gotten in between major swings, So like in between major swings, this was the start and the end of this swing. So in between, you have internal liquidity resting in between them. Similarly, you have this an external swing and this an external. You have internal liquidity resting in between them, internal liquidity. And also down there, there. And also you also have internal liquidity resting between the starting of this A and the end of the A wave. You have internal liquidity resting down there, and you also have internal liquidity resting down there. So how we use this example, I will draw this example. I will just use this corrective wave to just show you guys what I meant by internal liquidity, because you have internal liquidity resting above everywhere down there, but we use this correction, this retracement, and I'll show you guys the internal liquidity resting down here. So from wave A, if I should zoom in to this retracement to get the internal liquidity, from the start of wave A to the end of the wave A, you had an A, B, C, a three-wave pattern. So you can see that this is the A wave, the B wave, and the C wave. In between, you found that the banks were also buying and selling in between A wave. So at this end, they sold, they bought from down to this end, and from there downwards they sold. So you have liquidity resting down there, which is called internal liquidity. I will use a different color. I will use the pink color to show the internal liquidity. You also have internal liquidity resting down here because the bought in between this major swing, the bought, and this never broke this structure. It wasn't a major swing, so it's an internal in between this major 0 and A. So they bought down here and they also sold at this end. So at this end was external liquidity. So in between this A and B, you also have internal liquidity resting in between them. Why did I say so? The banks bought at this end, which was the A wave, that led to this formation of the B wave. And at the end of the B wave, they sold the market at the end of the B wave. So you have an internal liquidity resting at the end of the B wave. And at this end, they bought the market. So down here, they bought the market, which was the, you say, external and the internal coincided basically. So a perfect example is between this major swing, which is the end of the B wave, and which is the beginning of the C wave and the end of the C wave. So the C wave is always the 5-wave pattern, where this is the first wave, second, third, fourth, fifth. In between, you have that the banks were also buying in between them. They bought heavily at the beginning of this C wave, and in between they also bought. So at the beginning of the C wave, well, that's where you had the external liquidity, and in between they bought at this end. So you had an internal liquidity resting down here. You also have internal liquidity resting down here, and they sold down here, and they sold down here. So what's the essence of internal liquidity and external liquidity? The thing is that the banks always take out internal liquidity and they head towards external liquidity area. So they take out internal liquidity and they head towards external liquidity area. So let's start from this example down here. This is an external liquidity and this is an external liquidity. in between them you had internal liquidity where they were selling in between. So you had some sell here, some sell action happening here, sell action happening down here, sell action happening down here. So you can get your trend line. I can say, okay, this is a trend line liquidity or internal liquidity. Because so what happens at the banks? So when, like I said, when you mention liquidity, you mention stop loss. So you have stop loss, stop loss, stop loss, stop loss. So what happens that the banks are going to go upward, take out all these guys that sold with their stop loss resting above there. You can see what happened. It took them out and they head towards what? This external liquidity resting down here. So banks take out internal liquidity and they head towards external liquidity. Another example is down here in this fourth wave also. Why they were taking out this external liquidity, why they were taking out this internal liquidity, they also had internal liquidity being generated. So you had them having the buy the stop loss place there, buy stop loss place, buy stop loss place within this fourth wave. So what happened is that the banks took out the internal liquidity resting on this fourth wave using this fifth wave. They took them out and they head towards this external liquidity area. So it took out this internal liquidity, the stop loss from the buy, and it sold heavily. So when it sells, it takes them out of their stop loss. So when this comes down, and let's say they buy around there, it comes trigger their stop loss, same also trigger their stop loss, and it heads towards an external liquidity area, which is at this external end. That's why you have this stuff down here. So in this market, where do you think the market is going to head to? This market is going to head towards this first external liquidity was this ends down here. It's going to head to this area down here, which is an external liquidity. If it doesn't attain a form of support, if it doesn't attain a form of resistance around this external liquidity, the next external liquidity is going to go to will be this area of external liquidity, and that's when you will say that we are now in a reversal and not a retracement. So since this C wave is a 5-wave pattern, on this fifth wave, what to expect a 5-wave pattern because it's an impulsive bullish wave. So what to expect a 5-wave pattern within it, and I hope the market gains a form of resistance around this external liquidity. So what happens is that the market is going to take out the internal liquidity resting on this fifth wave because of the sell action that was taking place. You can see a sell happened down there, a sell happened down there, a sell happened down there. So the market is going to take out all this stop loss from the sell action to trigger their stop loss and head towards this external liquidity. So the market takes out internal liquidity, which what you have in form of stop loss placed above here from the sell action, and to head towards this external liquidity resting on a major swing. So we have to get our first target around this place. So if you take a buy trade from here, your target should be around this first external liquidity. And secondly, before the banks took this sell trade, they bought the market before selling. And secondly, even though the banks took a sell trade down here and they made so much profit from this bearish move, they still had an open buy position, because before institutional traders, before they take a sell trade, they buy the market before selling. One of the reasons for doing that is because that's a way of shaking out retail traders and for them to get a very good entry, because these guys trade billions of dollars on a daily basis. So they're the ones that move the market. If they move the market to that direction, they could also manipulate the market in their favor. So one of the ways they do that is by selling before buying. So they sell to get a very good entry level before buying. So they still have an open sell position that the market will still have to go up and close. Even if it doesn't close it, at least they break even. They don't make a massive loss, because the banks hate to be at loss. So that's another way of looking at it. So you also look at it as you have an open buy position that has to be closed from taking this sell trade. So this is an external liquidity, and also the open buy position is a more reason for the market, the price, to head towards this area before going downwards. So what happened is that, from to zoom in, going down to the lower time frame, or before going down to before going down to lower time frame, I would try to zoom in. This is the get my trend channel. Can get the fractals of this. So if I get this is the first wave, second wave, the third wave, fourth and fifth. But I can't really see the fractals properly. Put it in red. I'm going to go down to lower time frame, like the daily time frame, to see what's happening. How this market is. That's why you have the candlestick looking like this, but there's a secret formula I use. I use the Helkin Ashi. I can't pronounce it properly. I think it's a Japanese word or so. But that will just filter out the noise. So you can say what you get a full candlestick. So you can see this is the end of the third wave. So this is going to be end of the third wave. Then the fourth wave. And what comes next will be the fifth wave. And at the end of the fifth wave, what's going to happen is that the market is going to the market is going to attain a form of resistance at this area. And then what comes next will be a bearish move downwards, which is going to be the market is going to attain. So as you can see, this is going to be so guys, this is going to be a 5-wave pattern. Put a different color. So this is going to be the first, second, third, the fourth, and the fifth. And once the market gets to this area, it's going to attain a form of resistance around this area that will lead to a reversal or a continuation of the previous trend, which is a downtrend. So what's going to expect next will be 1, 2, 3, 4, 5. So that will lead to a break of this structure. So what's going to happen is that the market is going to come, take out all the internal liquidity. You have internal liquidity resting down here from the stop loss, stop loss, stop loss. So it's going to take out all the internal liquidity and head towards this external liquidity area, which is at 1.32 naira. So you can see it's going to head downwards towards this external liquidity. So the market is going to take out internal liquidity and head towards external liquidity area. So in summary of my analysis will be, this is also a downtrend, first wave, second, so fourth, and the fifth. And after a bearish downtrend, what comes, could that be a retracement or a reversal? And since this move upward hasn't broken this structure yet, I'm going to treat the market as a retracement and not a reversal. And since the retracement is going to be an ABC pattern, a 3-wave pattern, and with either my trend channel, I can get the extremes. So it's going to be A, B, C. And I said on the formation of this A, B, C, you have internal liquidity resting in between this B and C. So from this 0 to A, you have internal liquidity resting there. In between B to C, you have internal liquidity resting down there, and you have external liquidity resting at major swings in the market, which is there. So what happens is that the market will get a form of resistance at the end of this external liquidity. So what's that happens that the market will attain a form of resistance at this external liquidity area, or picture it as before institutional traders, before they sold this market, they always buy before selling. So the market has to mitigate and close their open buy position before them selling more further. So if this is a retracement, what to expect at the end of this ABC pattern will be a 5-wave pattern that will lead to a continuation of the bearish trend. So what to expect will be the first, second, third, fourth, and fifth. So the market is going to head towards this external liquidity area. So it will do that by clearing this internal liquidity and heading towards the external liquidity area. So for those that want to take advantage of this market, that want to buy on a short-term basis, you can still buy on a short-term basis, but you have to be aware that this won't go on for long, because the C wave is always the 5-wave pattern, and presently you're on the last bearish, and presently you're on the last impulsive 5th wave. This is the 5th wave, and at the end of this 5th wave, there'll be a form of resistance around there that will take out the external liquidity resting down here, and then to use that liquidity as a fuel to push the market downwards and take out all the internal liquidity resting at this end, down here and down here, and head towards this external liquidity area, which is this 3rd wave, then a retracement and a break of the structure. And that's it, guys, for this analysis. If you like what you watch, don't forget to like, comment and subscribe. See you guys on the next episode. Thank you.